So I guess as we, before I jumping into the content, we can start with just some housekeeping reminders. If you'd like to ask a question, there's a Q&A section at the bottom. We already have a question. I love it. So you can go ahead and type in your questions as you think of them. And I'm going to be checking into them periodically throughout today's webinar. So my expectations, our webinar is going to be about 45 minutes. We did move it up a little bit because of the Dodger game. We wanted to make sure that we could all participate and then hopefully go enjoy a victory this evening. So again, just housekeeping, ask questions as we're going through this, and that's, I think, kind of it. So, and if I don't get to your question, we are going to be making note of it, and then I'll make sure that we respond in an email. And, you know, it's also really hard to answer specific questions around a specific situation. So hopefully you can keep it more broad-based around economic, political issues, things like that. So, all right, so let me minimize that. All right, so I'm going to go ahead and get us started, and I'll get my PowerPoint going. So, all right. I feel a little rusty. I haven't done this in a little while, so I need to share my screen. That's always the first place to start. Okay. All right, thank you. Welcome, everyone. It's October 27th, 2020, a week away from our election. We did have to push back our workshop a little bit, or excuse me, our webinar back a little bit, just because I was out of the state. Actually, last week, my daughter and I went on a nice little road trip to visit a few colleges. I was working in the morning. She was doing school via Zoom in the different cities that we went to. So it was a great time, great memory. I'm back kind of ready for a year-end push here. One of the things that we do know is that our communication with you is going to increase just because of the uncertainty with the election. Probably the outcome of the election is going to cause some newfound volatility that we're accustomed to, but we haven't seen in a few months. So we'll be here. We're going to be available to answer questions. We might ramp up our webinars and do more frequently, depending on the results and depending on kind of any sort of, I guess, economic or market issues that we need to address. We also might be getting into some more specific topics on, you know, how business owners can, you know, deal with some of the year-end planning needs. And so just keep an eye out for our content. We are going to do our next one that's going to be more broad-based will be 2 weeks from today on November 10th. So it'll be a little bit more just current events, what's going on, any kind of fallout from the election, things like that. So also Jared Ferguson, Vice President here at Vance Wealth, he wrote a really good article on, you know, the upcoming election, the impact on the markets. I think we're going to try to get that out via blog either Friday or Monday, and then that will also be posted in our newsletter for the fourth quarter. So here's today, current economic update, nothing fancy. Plus, I'm going to go through some year-end tax planning ideas. I'm going to kind of set the stage for that because clearly, based on the election, there's going to be some different planning that might be necessary. So without further ado, we'll begin. So it's our disclosure. This is actually technically our first webinar as our own registered investment advisor, RIA, Vance Wealth Inc. And so I thank you all for kind of getting all your paperwork back to us in an expedited fashion. We really appreciate that. And, you know, we're definitely looking forward to serving you and giving you unbiased fiduciary, you know, driven advice. And, you know, thanks for your trust and confidence in us. And, you know, we're here to help. So here's our disclosure document. And as we go through, here's really our agenda for today. Talking about the road to recovery, primarily from a financial perspective, why we are optimistic about equities, meaning stock investments, equity performance surrounding elections. A lot of you have opinion about what's going to happen with the election. We do as well, but nobody knows. We don't have a crystal ball. And there's a lot of misinformation around what happens around elections. So I'm going to share some of that with you. Market volatility, asset allocation, and then year-end planning considerations. So we're going to go through those items. So, okay, I'm just going to keep an eye out for questions as well. So COVID-19. So that's obviously been dominating the headlines. I think by now, most of us had hoped that this was going to kind of slowly maybe wean or die away in the summer months and coming into the election, and it has not. I think the big thing that we're seeing now, and still that the question remains, are we going to have a big second wave? It looks like we are seeing some spikes. And so I think that's obviously unnerving the markets as we head into the markets and the health community, as we head into a kind of a sicker time of the year, meaning the winter, flu season, things like that. So definitely these headlines are going to create a lot more volatility in the markets, a lot more fear and concern, especially with those who are more at risk. And unfortunately, because of the political dynamic that we're in, we're not getting a stimulus bill passed. Both parties have kind of, dug their feet in the sand and said, what, we're standing ground. And unfortunately, there's a lot of Americans that are going to be negatively impacted by that. And so, one of the things when we start talking about the financial markets, we are looking at, there's many people, many industries that are thriving. Unfortunately, there's about 20% of America that's really struggling. And so I know that's what a lot of the stimulus is there to help with. And unfortunately, because of the political dynamic that we're in and the fighting that we're all seeing, nothing's getting passed. And it doesn't look like we're going to get something passed. And unfortunately, depending on the outcome of the election, we might not have any real stimulus until next year, depending on how the political fighting continues. So a couple things when we start looking at it and assessing, obviously we went into a recession. We talked about this really early on. We went into a recession right away. Now, officially, it takes 6 months to be technically declared a recession, but we knew it. We went into a recession, and it was sharp and it was deep. If you look over here on the right-hand side, this was actually the sharpest recession we'd ever seen, and also the shortest decline, meaning the recession happened quickly, and the recovery is I don't want to say already occurred, but we're in the process of improving. And this is unlike any other recession that we've had in our past. Which is pretty remarkable. These are all data points on this right-hand side going back since World War II. Let me get my little pointer here. Going back since post-World War II America, all of these data points, which shows basically the magnitude of the economic decline and then how many months that we are in recession. So most of the time we're in recession for 10 months and longer, and then the rate of the decline is not that actually severe. It's just a slowdown. But you can see what we just lived through. It was quick, painful, but we're on the mend. So you can see some of the data kind of on the left-hand side. And really what saved this was the fast stimulus that came in from the Federal Reserve, from Congress, from the White House. I mean, it was just massive amounts of stimulus coming in the system. Now, we can all be armchair quarterbacks and really look back and say, okay, was this the most effective way? Could there have been better ways? And of course, the answer is yes. They could have done things differently. They could have done things much more effective. But when you're living in the middle of it, it's always easy to second guess. No one has a crystal ball. And so the decisions that they made really helped create a floor in the decline, and this is now allowing us to recover. But this is going to be one of those things that I think historians are going to look back and say, you know what, they did this wrong, they did that wrong, they did these things right. And unfortunately, you can't be perfect in this, but they took swift action, which is one of the reasons why we are on a mend. But at the end of the day, the only way to truly fix this is to get the economy back open. And so whether that's just time, letting the virus kind of die out, or if it's going to be a vaccine, we've seen a lot of headlines around vaccines. Nothing that's getting that exciting other than just hearing it's promising, but we don't know what that means. And I pulled out a slide from this, but there's a lot more Americans now who are distrustful of getting that vaccine, that they're worried about it. And so, we'll see, but that's really what we're seeing, especially the state of California is a lot more locked down than other places. And that seems to be what's going to really get us on the path to sustained recovery, is where we can open back up and put the protocols in place to remain healthy and to allow the economy, to allow citizens to go back to some normalcy. So I guess the good news with all of this is we are recovering, but the full recovery is not going to be in place again until we get back to some normalcy. So if you look at what's been going on, what's happening in the third quarter. So let me go back a slide. While the second quarter and what we saw this recession was the steepest decline. It's no surprise because this tends to happen in economics. the third quarter of 2020 is likely going to be the strongest quarter on record. Well, when you take out all demand out of the system and then you open it back up even slightly, most of that demand recovers. And so if you look at these charts, areas where we're seeing what's called a V-shaped recovery, which means sharp sell-off followed by a bounce back. You're seeing that in improved consumer spending, because for the most part, most consumers have plenty of money in their bank accounts. Unfortunately, they had to travel, they had to cancel vacations, a lot of discretionary spending around maybe going out to eat, things like that. So they have extra money. Their credit card bills are a lot smaller. So consumer spending came back. Robust housing market. I don't know if you've seen the data, but housing market is on fire, especially in suburban communities where people are leaving some of these larger cities. So robust housing, stronger manufacturing. Manufacturing is on the mend, and then vehicle sales are picking up. So, we saw the sharp drop off, obviously, in the closed down economy. People aren't going to go buy that new car. They're working from home, but we're seeing a sharp bounce back. So the recovery is on the mend. The question becomes, is it sustainable? Is this going to get worse before it gets better? And we tend to be in the camp of it's going to get better. It's not going to get worse. And I have some data why. So we started talking about this K recovery, and this really came from the economic team at Raymond James, the economic and investment team at Raymond James put this together. Now you're starting to hear this more in mainstream on the, out of some political correspondence, out of some major news publications. I don't know where they're sourcing it, but the first recollection that I have, the first reading that I had actually came out of Raymond James. So pretty fascinating. And so this K-shaped recovery is basically this idea that not all industries are created equal, and that we're going to go through this recovery that's going to just not be a one size fits all, where we're actually going to have certain economies that are going to be thriving, and we'll go through those, and those that are going to be kind of in a long-term decline. So if you think about this path, and if you follow kind of the cursor here, and you see me do this, so I know this is potentially a little bit of a repeat for some of you, but I think it still is worth mentioning. Right when this pandemic hit, we had some industries that went through the roof. Amazon is an example, or Netflix. Things where people were working from home and stuck at home, and so internet, direct marketing, technology, wireless and telecom services, interactive home entertainment, household products, right? When you couldn't buy toilet paper, think places like Procter & Gamble, Colgate, these kind of household products did really well. So this part of the economy has just been on a trajectory upward. They've seen a big boom because of COVID. And then we've seen this next economy that just went straight down. And when I say straight down, it's obviously hasn't gone to zero, but look at the industries that have just been decimated. Oil and gas equipment, oil and gas exploration, integrated oil companies, those would be like the Exxon and Chevron, hotel and resort REITs, real estate investment trusts, and then retail REITs, right? So those would be mainly like malls. So think about their dynamic. They can't go back to any sort of normalcy because of the demand, because of the shutdown of the economy, and they're going to be negatively impacted for a long time. Hotel and resort REITs, when we get back open, they may be in this next time, this recovery, but right now they're not. And then if you look at after that initial panic, after that initial sell-off, we saw this recovery. Well, what's been benefiting from that? Home building, computer retail, home improvement retail, internet services, building products, biotech, medical supplies. So this saw a pretty immediate bounce. And then this last little group here, which are the industries that we know are going to come back, but they're going to look a lot different. Restaurants, auto manufacturers, apparel companies, hotels, resorts, cruise lines, airlines, right? So we know those industries are going to remain intact, but what they're going to look like at the other side of this is going to be very different. One of the interesting things, right, if you own a broad-based stock market portfolio like the S&P 500 or some sort of index, what do? You own when you own that, you own all the industries. One of the reasons why we like having different managers in the portfolios, because we want to have some focus areas where maybe we avoid some of these lower performing asset classes. And so that's really into some of the portfolio construction that we're doing on behalf of our clients. But if you start seeing like what we call real-time indicators, look at the drop in demand. Gasoline demand dropped 10%, hotel occupancy 32%, TSA screening 66%. So massive changes. Once we get through and COVID's behind us, we're going to be, these things will be on the mend. But what's going to be really interesting too is this going to be some sort of a new normal for us, that every 3, 5, 6, 10 years, are we going to be dealing with some sort of pandemic that might lead to any sort of shutdown? And is this going to have a permanent negative impact on some of these industries because of the reality of what the future economy and the future health environment might look like for us as a nation and as a world? So equities. So you can see my little note over here. This is came from a Raymond James presentation. A lot of these slides, they had some really good data. But valuations, one of the things that we're seeing is valuations are elevated. So everyone's concerned stock market's too high, stock market's too high. You know, you always have to ask your question as well. Too high is that's a relative term. So what do people mean when they say it's too high? Well, just because it hits an all-time high doesn't mean it's too high. I mean, I can give you an analogy on on your house. Your house essentially is hitting all-time highs at all, forever in the history of you owning your home. Every year it tends to go up a little bit, right? So that's just the nature of inflation and home price appreciation. So just because things are at highs or all-time high doesn't mean they're too high. Well, with that being said, valuations are elevated, meaning they are high, but they're still attractive on a relative basis. And relative means relative to what? So if you're going to make a decision with your cash, with your money to invest, where are you going to go? Right? You can buy stocks, you can buy real estate, you can buy bonds, you can invest in cash or park your money in cash, I should say. So those are kind of the buckets we can look at for alternatives. So relatively, because interest rates are so low, we're at historic lows, and we all know bank account payouts, interest rates are super low. We are now seeing that, equities on a relative basis don't seem as overvalued as maybe one would think they are. So that's kind of our overall thing is yes, elevated, but on a relative basis, still attractive. Pretty interesting though, is what we've seen this year is the what we would call dispersion, meaning difference in performance in certain industries. So this is the going back basically the last 15 years. What this chart on the left shows is sector dispersion. So basically meaning if I compared technology versus energy, and we're seeing this year, the best performing sector is outperforming the worst performing sector by 80%. And, typically that is more of an average of 40. And you can see here, so we're obviously stretched. So winners have been winning, losers have been losing big time. That's probably a trend that's going to continue here. But, at some point, what happens when things go down in value, they become cheaper. They become sometimes more opportunistic or even a better opportunity. But if you actually look, some of the dispersion inside of industries is pretty remarkable, right? Casinos and gaming down 36%, interactive home entertainment up 33%. And I'm not going to go through all of these, but if you look at hotel REITs, down 41, industrial REITs, real estate up 11. So massive amounts of differentiation in between, right? Look at down at the bottom, airlines. Airlines are down 45%, but air freight is up 47, right? UPS and FedEx are doing great. And actually a lot of airlines are moving freight right now. They've decided, well, if we can't put passengers in there, let's move freight. Let's move goods because we're seeing so much in the way of online sales, right? So this dispersion inside of industries is going to continue. We do think this next 10 years is going to be really an amazing growth cycle for a lot of different industries, or an amazing growth environment. And I'll share a little bit of that with you today. And I have over the last, several months. But why are we optimistic about equities? So if you think about where we are, so down here, early innings of a bull market. Now, I don't know, again, this is a piece that came, I believe it's from FactSet. I don't know if I fully share that we started a new bull market, right? Because the market crashed down so fast, it went down 35% from top to bottom. And so technically we went into a bear market, which is a declining market, and now we're back in a bull market. So technically that occurred. However, so are we really at the very infancy of this, or was this more of a COVID-induced recession or a COVID-induced bear market? And it really wasn't, I guess, a real bear market because of the fact that it was induced by a mandated government shutdown, right? So if you look at historically, we've seen bull markets run for long periods of time, right? This longest one here on record was 1987 to 2000, right? 13 years. And so we were even making the case last year that, we're 11 years in this, we still think we have many more years to go. So if, according to experts at Raymond James, I can get on board with this, even though I would maybe look at things a little bit different, but we're still early in a bull market. Earnings growth are definitely improving. So while we're seeing massive disruption with certain industries that are not coming back, not functioning well, those are already low profitability industries, meaning they didn't make a lot of profits. They had poor margins, so they already did not make up a big part of the stock market. So we're seeing earnings growth improvement, record low interest rates, which is, it's pretty crazy. So 76% of the S&P 500 have a better dividend yield than the 10-year treasury. Okay, so think about that. That means if you buy a stock, which you would think of as a long-term growth investment, you're going to get more income on a annual basis from 76% of the companies than you would from buying a 10-year treasury. So it's making them more attractive. So when we're putting our money to work, when you're putting your money to work, when investors put their money to work, they're looking at these things and saying, well, you know what, stocks still look pretty attractive when I compare it to the alternative. This is the big one. This is, I guess, what I would say we were pounding our table, or pounding our fists on the table saying, you know what, the markets are likely going to go higher even in the midst of COVID because there's so much cash on the sideline. So there's something like $4 trillion in money market funds. And generally what happens is you get back to some normalcy, this cash finds its way into investments, which is why we think stocks are going higher and real estate's going higher. Also what's called positive seasonality. So generally in the fourth quarter, stocks tend to do much better. So a couple things that I'll show you the data on, but near record cash balances. So if you look back here, this last peak that we saw was in 2009. So this was kind of at the tail end of the Great Recession, which we remember how painful that was. So usually what happens early in a pandemic, early in a recession, or in a panic, you see cash gets elevated. So we saw that back here in 2009, and then the cash gets back to some normalcy, meaning people get their money invested. But you know, not all cash is designed to be invested. Some money is just designed to stay in cash. And so you can see we got back to a more normal level. Now we're elevated. And so what we'd like to see is as this cash comes back down, it's going to find its way into investments, and we'll probably settle into a new normal, probably, you know, somewhere above this, because the government's been printing a lot of money. We don't have time to solve all the economic issues, but that's definitely something that's been happening in this recovery, is a lot of money's been just pumped into the system. So high amounts of cash, generally that bodes well for the markets. The thing that I also find fascinating, and this is a little bit along the lines of what we'd call investor psychology or investor behavior. Going back to 2001, you can see this shows the amount of money that's going into equity or stock-based mutual funds and ETFs. And if you look at it, we've seen this massive decline. So the headline up here is the most unloved bull market. So that's actually a sign of health. So when you see that people are leaving, when people are selling and markets are still going up, that means there's still a lot of pessimism, which means there's probably still more room to the upside, which we do share. We do share that opinion. And so this will probably, start to trend a little bit higher, but it's definitely been a trend that we're seeing, is it's a very unloved, a lot of fear out there, a lot of pessimism. And, that's why we always hold on to your investment strategy needs to match your time horizon, your financial goals, and the short-term stuff like an election is just hard to predict. And we don't want to let it, dictate our investment decisions. So when we talk about some overweight sectors, and this is just one theme, but one of these obviously is 5G, right? We're going to see a massive infrastructure change here to get ready for this 5G outlay. We're already seeing some companies, a lot of the wireless providers, even Apple, announcing their first 5G phone. But these areas are definitely going to benefit from this: information technology, communication services, healthcare, consumer discretionary. These are definitely going to be the sectors that are going to have the most amount of growth. But the challenge with managing a portfolio is that, yes, these are the obvious winners with growth, but at some point, these companies can get too expensive, right? So we still want to maintain balance. We don't want to just load up on just these industries. It is important to maintain balance, but these are clearly going to be the winners in this new reality in terms of where the growth is going to come from. So let me address one of the questions, because it did deal with some of the cash. So one of the questions that I have that says, according to the Wall Street Journal, the major banks are flush with cash. What effect will this have on our investment strategy? So when you start thinking about the impact on the investment strategy, so the banks are flush with cash. One of the reasons why they have a lot of cash is the Federal Reserve has been pumping money in there, because the health of any economic system is the health of the banks, right? If the banks are healthy, the economy can function. And how do banks get healthy? Well, they have cash on their balance sheet. They have cash on their books, so that if they have failures, right? If people default on loans, if people default on, like, say, real estate loans, car loans, things like that, they have enough reserves so that they can weather a storm. So the simple fact that the banks have a lot of cash is a good sign for the health of the economy. And so I don't know, it doesn't really drive or change an investment strategy. It just kind of reaffirms of why we still feel confident in staying and being a long-term investor and not letting some of this, letting COVID, letting the election, letting things kind of dictate our investment strategy. So we just see that as a healthy sign of the fact that the banks have reserves so that they can weather a downturn. So if we slip into another recession or if some other bad news comes out, because they have cash, it gives them a little bit more of a cushion, which we like. All right, so let me move on to the next one. So this was a little bit more of the same, kind of this idea of the K economy, the K recovery. And so what I'm looking at here on the right was just the data points that I thought was pretty fascinating. So this represents year-to-date performance based on these 4 areas, right? The top left, the bottom left, which are the more struggling companies, excuse me, the bottom right and the top right. So you can see all the differences. So it's no wonder that if you look at how the markets have done, on average up 4%, but if you actually look at those that really kind of took off like a rocket ship are up 44%. Those that were in the first wave of recovery up 22%. And then those industries that are really struggling are down pretty substantially. So you can see that, I mean, not only does this conceptually make sense, we're seeing that the numbers are also playing out, that there's really a batch of winners and losers. And, you know, when we look at what we think this recovery is going to look like, and it's an interesting dynamic, and there's part of sadness in it as well, because we do think coming out of this 10 years from now, the landscape of a lot of our small business owners, the landscape of even a lot of just companies in America is going to change, because going through this, we're going to have companies and individuals and people that are going to thrive, that they're going to take the reality that we're in, and they're going to thrive and do even better things. And their companies are going to get better and stronger. They're going to become financially stronger, more wealthy. And then unfortunately, we're going to have individuals, industries, and companies that are going to struggle, that aren't going to adapt, that are going to find it difficult to manage and change their business and adapt. And, you know, that's kind of the pros and cons with capitalism, right? Those that adapt can thrive. And so, but I do think that because of this kind of forced change, meaning this was forced upon us, because of the shutdown, that it's going to cause maybe more disruption than normal, which again is, if you're opportunistic and moving forward, and as an entrepreneur, that's kind of my attitude, is move forward and try to get better, try to get stronger, try to improve. But there's definitely going to be some fallout, which is going to create some a decent amount of pain, which, you know, nobody wishes on any individual, any business, but it's unfortunately going to be the reality. As an investor, the good news is we get to cherry pick. We get to decide where do we want to put our money, and that gives us the, I guess, the opportunity to be a little bit more selective. So I think I had a question come in. All right, let's see here. One of the questions said, addressing how the recovery will change depending on who wins the election. So I guess I'll come back to that. So the question is, based on the outcome of the election, and really what we're referring to is if it changes from Trump to Biden, you know, what's the recovery potentially going to look like? And so I'm going to go ahead. That's going to be a little bit later. I do have some slides on that. So we all have opinions on that. So I want to be a little bit careful, because at the end of the day, we don't really know. But we all have opinions. I will talk a little bit about tax policy. What happens with the stock market is a little bit different, right? So the stock market's its own animal. What happens with the economy is going to depend, right? So, but let me take a pause on that question, and I'll address it as we get into some later slides. Okay, so I think this wins the award for the most noisy slide that I have today. But it's actually really easy to read. So that's the good news. So I actually went back to basically 1932, and we looked at presidencies and said, all right, well, you know, is there any trend of like, is a certain, I know Republicans always feel that Republican president scenarios are always better, and Democrats feel the flip of that, right? So, but when we look at the data, it's actually pretty neutral. You can see here, going back to 1932, we've had negative years in the stock market. We've had 26 of them over the past roughly 90 years. And 13 of them were during a Republican president and 13 during a Democrat. Then if you look at the average return, so going back to 1932, a 8.6% rate of return for Republicans, 8.5 for Democrats, essentially a tie. And then GDP growth where there was negative, meaning recessionary, 8 versus 7, again, essentially a tie. So there's not a scenario that says this is a scenario that always wins. Now, depending on your policy choices and what you care about, what's important to you, of course, there's winners and losers with any administration. But in terms of just looking at broadly on an average basis, the results are pretty mixed. And what this shows me is the confidence in our system, right? We have a capitalist nation that favors competition, that favors a system where we have free elections and we change power and we do it in an orderly fashion. Now, I know many people are thinking that's not going to happen this time. There's definitely going to be more fighting. One of the things that Jared Ferguson wrote in a blog post for us was that this might be more contested because of a lot of the mail-in voting, that there's still going to be a lot of mail-in voting that's not going to be counted, and that the states actually have time to certify their results. And I think it was through like December 8th. So there is going to be some time. It's definitely, we've already seen this. There's going to be a lot more fighting. We know that. Unfortunately, I think that's kind of the byproduct, a lot of the social media. But you can see here, the data would suggest that either scenario kind of gives us the same results. And if you look at what the annualized performance, so this is just looking at the S&P 500. This is the annualized performance going back, and you can see we do have any that were Democrats are in blue font, and then any Republicans are in red, and you can see different histories, right? So you can go back to periods like Eisenhower was 10% and Kennedy averaged 5, and then Nixon was -4, and Jimmy Carter was 6, and Clinton was 15% a year, and Ronald Reagan and George H.W. Bush were over 10, right? So there's just different results, and so we get this question from you as clients every election cycle, and depending on where you sit, I would kind of argue with all of you is that we all live somewhere here in the middle. We're all some semblance of the middle. We don't live out here on the full extremes for the most part, right? So we live somewhere in the middle, which is why this data doesn't matter, right? Because we're kind of moving the target in terms of policy. So immediately what's going to happen if Trump wins? I don't know. If Biden wins, is the market going to go up or down? I don't know. It's not really asking the right question, because as a long-term investor, you shouldn't just be making a decision based on one event, because most of us are investing over a lifetime, which we're talking about generations, decades. And even though many of you are on this call are probably retired and saying, I don't have that time horizon, but you have enough where, this sort of historical precedent is relevant. So some other interesting data that I'll share with you, because I know we love a lot of this data. I think I'm doing good on time. So this basically shows in an election year, when the incumbent party wins, what the stock market does leading up to the election. So this line right here is election day. So when the incumbent wins, the market tends to be positive, this on average 8 to 10%. And then if you see here, when the incumbent party loses, it tends to be closer to 0. Well, right now, the markets, we're closer to that 0 line than we are the 10% line. So don't know what the results after, but what's pretty fascinating in both scenarios, if you look at post-election, what happens? Markets are higher through year end. So for whatever that's worth, history does not always repeat itself. But then if you look over here, average return by presidential year, right? So, we look at an 8-year time frame, clearly, because we have, some presidents that make it 8 years. And in the 4th year, so what this basically shows is the percentage of time that's positive that doesn't sound right, but it looks like it's close to 100%, which kind of surprises me. So, but then you can see the average performance is closer to this 10% range. And so the good news is you tend to have decent years or decent performance in election years. That's at least been historically what we've seen. One of the things that becomes a really big factor is obviously diversification. If you look at the past, goes back about 30 years. What stocks do relative to bonds over the last 30 years, you can see bonds are up about 500%. Stocks are up about 1,700% over the last 30 years. So 100% stock portfolio generally is outperformed. And what this is just designed to show you is volatility, right? So when we have a portfolio that's 100% in fixed or a portfolio that's 100% in stocks, one of the things that we know on a one-year basis, all of these charts basically show the type of volatility that we can expect. So when you have a really conservative portfolio, your return is lower, which is this dark blue, and your results are in a tighter band because volatility is less. When you go to a more aggressive portfolio that's 100% in stocks, then the volatility expands out to the upside and downside, and you tend to have a higher annualized return. And this gets even, the return difference gets even more amplified on a 5-year basis, but the volatility it narrows, which is one of the reasons why, as advisors, we're constantly saying have a long-term outlook, because we know over time, volatility becomes less of an issue when you have a longer-term time horizon than when you have a short-term time horizon. All right. So I got a question here, which is a good one. I don't have any slides on this, but I definitely can answer this. So please discuss future inflation on goods, which we are already beginning to see. So great question. So inflation is really, I think, probably the one economic issue that we're starting to see a lot more headlines around is what's going to happen with inflation, right? You know, the numbers that we're seeing out there are staggering, right? Trillions of dollars. I mean, that's even hard for any of us to fathom, like what $1 trillion is, right? So, and we're talking about multiples of that. So the inflation kind of conundrum, the Federal Reserve, their mandate is two things. Number one is to have full employment, which for all intents and purposes, they measure it as roughly 4 to 5% unemployment. So they want to have full employment, which means our economy is functioning because people are working, and they want to have modest inflation, which for the most part is targeting an inflation rate at 2%, 2.5% roughly, right? So that's kind of their mandate. They try to keep those things in balance. And if not enough people are working, they'll cut interest rates to create some inflation to get people back to work. So that's really what they're balancing. Well, we've been in such a disinflationary environment, which basically means low inflation, for over a decade because of the impact of globalization, importing goods from China, because of technology. Technology has been a massive disruptor when it comes to inflation, because technology is making things easier, faster, cheaper. And so the Fed, for the first time that my short career is approaching 25 years, but it hasn't been that long. It's the first time that the Fed has really come out and said, we're not this directly, but has essentially said, we need to cause inflation. We need some more inflation. We can't run at sub 2% inflation. So they're trying to create some inflation. So we're definitely going to start to see a little bit more. The question is, can they create it? I don't know. I feel like they've been trying to create it, but they did make a stipulation that they're going to essentially make an attempt to create it. Now, the thing that I know we're seeing inflation of with certainty is in real estate and in stock prices. So in asset prices are going up. The question becomes, are goods going to go up? Are services going to go up? And the goods that are dependent on technology are not going up. The goods or services that are dependent on people, they are going up, right? Because the cost of people, the cost of minimum wage, the cost of benefits, the cost of workers' comp, all of those things are rising, right? So we are seeing inflation in certain pockets. My guess is the Fed's going to succeed, and we will see some more inflation, which is another reason why you can't afford to park too much money in cash. Because if your cash is making 0.5% and inflation runs at 3%, you're losing 2.5% every year to inflation. You don't see it, but it's eroding at your purchasing power, which is one of the reasons why we're big believers of being invested, is maintaining your investments and your allocation and things that are going to grow over time. So inflation is going to become more of an issue. Again, I think they're going to try to do it. And inflation in their mind is an easier way to essentially tax your money. So let me give you a quick analogy with that. So the government essentially has two ways to kind of pay for this debt. Now, I don't think the government has any intention to ever really pay off our debt. They just got to get it manageable, because our debt is approaching 30 trillion. And I believe at the turn of the century, we are close to like 2 trillion, right? So it's gone up from 2 trillion to 30 trillion in 20 years, which is mind blowing. But I do think that, so the government has two ways to really deal with that debt. Number one is they can increase taxes. Well, we know how unpopular that is, right? You don't want to have more money out of your paycheck. You don't want to pay more taxes. Nobody wants to pay more taxes. That's super unpopular. So the other way is through inflation, because over time, if prices go up, that's going to drive tax revenue higher, right? Because most of our tax revenue is a percentage of something, a percentage of goods, a percentage of your income. So if everyone's income goes up, if everyone's income doubled overnight, which wouldn't happen, but if it did, and the tax rates were identical, what happens to tax receipts? They double, right? So that's kind of the hidden way that I think our government's going to try to manage a little bit of this, is to create a little bit more inflation. I think we're not going to see hyperinflation, but I definitely see where we could have inflation higher at 3%, 4%, 5%, which is a good news for people who have debt. Because if you have debt as an individual, you have student loan debt, the best thing that you can have happen is you want inflation, because your debt is usually fixed at whatever you took out for student loans, or you took out for your car, or you took out for your house. And then if because of inflation, your wages keep going higher, you get to pay off a lower amount, a cheaper debt with higher earnings. And so I think that's definitely going to be a byproduct. We're not seeing that yet, because again, technology is a massive disruptor in inflation. So they haven't been able to create inflation, but I think with some of the policies they're putting in place, some of the stimulus money that's going to go out, we're definitely going to see some more inflation. It's starting now in real estate. It's starting now in stocks. Will it trickle? I think it probably will, but how quickly, I don't know. It's a little bit of a guess, but that's a great question. I know the inflation question has been something that I get all the time. I've been getting it my whole career. And it's been pretty remarkable how low inflation's actually been through that period of time. Okay, so we're getting into a little bit of the year-end planning based on the election outcome. This is nothing in here. This is not politically motivated in any shape or form. It's just simply the facts. So, and I'm going to keep it to just some tax policies based on what each has said. Trump really hasn't really espoused his policy. It's just kind of more of the same. He's talked about more cuts, but I don't think that's realistic. I think it's just going to be more of the same. So let me just walk you through a couple scenarios, and I'm going to show you a couple charts, and then we'll wrap up. And please, if you have questions, please jump in. We got nothing in the queue right now. So if Trump wins, or a split government, so a split government would be a scenario where Biden wins and the Senate is retained control by the Republicans. So either a Trump win or a split government means that tax policy is likely going to be intact as it is today for the next 5 years. And when I say the next 5 years, it's really including this year. So in our professional advice, if that is what happens, then what we want to do is we want to use the next 5 years to implement tax saving strategies, because what we do know is that we tend to see political leadership change hands. So it's either going to happen in a week, or it's going to be 4 more years. But, at least in my lifetime, I guess, except for the transition from Reagan to Bush, we've seen it go Clinton 8 years, Bush 8 years, Obama 8 years, right? So it's really been, when you get that 8-year term, I think our country grows tired of the party that is in leadership and says, all right, let's give someone else a chance, right? So Trump does win re-election, or we have a split government, the next 5 years we think is going to be critical to say, let's make sure our tax efficiency strategy, our tax planning strategy is really tight and is forward looking, because we probably will see higher taxes with the next administration. And whether that is going to come now, again, at this next election, or in 4 years, we want to be mindful of that. So these are things around charitable giving, qualified charitable distributions, which is QCD, lost harvesting, even something called gain harvesting, which means forcing income this year, and Roth conversion. So these are going to be things we're really proactive. From a Trump perspective, it gives us a 5-year window, or a split government, a 5-year window. And with a Biden win, depending on your income, it might just give you a 1-year window. We are anticipating, and we're kind of gearing up for a really busy year-end tax planning. So these are things that we're going to be doing probably a ton of Zoom calls to, to review your tax returns, to review the tax strategy, to make sure, that we're trying to optimize where you are, and everyone's different, right? So, if you're retired and your income is below 250,000, the tax conversation it's a moot point for you. It's not going to be an issue financially, at least immediately. It might be later. But if Biden wins and we have what's called, I guess, a blue wave, right? That'll mean full control of the government in all branches of government. There's already been a proposal that there'll be higher tax rates on over 400,000 of income, and the over 400,000 of income is purposeful, right? It's the top 1%. So if you're in that, I do believe that is going to be a 400,000 number for individuals and for couples, but I'm not entirely sure. So if you're married, I think the 400 is the 400 regardless. If that is the outcome, then we'll potentially force more income into 2020. So depending on where you are with your income situation, we might encourage you to try to take more income into this year because we know you'll pay it at a lower rate. And there are things like gain harvesting and Roth conversion. And so these are the things we're geared to help with in terms of running the numbers, maybe running it by your accountant if we need to, but these are gonna be the planning areas that we're really gonna dive into. So let me see here. I got a couple questions here. Let's see here. Our daughter is thinking about buying her first house, but is afraid that she might be paying an inflated price. Is it best for her to wait until the market cools or prices come down? So, you're asking me to put my crystal ball hat on. So that's a really hard question. I would tell you that if the house is affordable, meaning when you take a look at your monthly payment, which includes, principal, interest, and your taxes and insurance. If it's affordable based on their current income, living situation, I would argue that the price is not as relevant because we are still seeing that in a lot of environments that even though home prices continue to tick higher, that when you compare owning versus renting, that in a lot of neighborhoods, owning is still a little bit cheaper when you factor in some of the deductions. And so you might be paying an inflated price, but if we're right and there's going to be some more inflation in the system, and if that money is continuing to flow into the real estate market, that's going to push prices higher. The other thing is we had this quick recession and interest rates plummeted. What happens when that next recession happens? We're probably gonna have interest rates plummeting again, which means, you might get a whole new batch of refinancing at ridiculous rates that are in the twos. So I would say if it's affordable, I wouldn't be as concerned because I can say with confidence that, 10 years out, 15 years out, 20 years out, you're gonna look back and say that was a wise decision. Now, the only caveat that I potentially would be a little bit careful, and this is not meant to be alarmist, this is just my personal opinion. I do think some of the big cities are going to struggle. I think, the heart of Los Angeles, I think the heart of New York City, Manhattan, I think the heart of Chicago, I think the heart of some of these big cities that have, that are going to be faced with some big challenges, San Francisco potentially, where higher earners that were kind of forced to live in these cities because of the jobs now can go work elsewhere. And if you see mass exodus of higher earners into suburbs or low tax states, that could have a profound impact on a real estate market that potentially is overpriced, right? So, and I say potentially overpriced because, we just don't know. Just because they're higher doesn't mean that they are for sure. So it's a great question. I think if it's affordable, that should be the driver of the decision, not trying to pick the perfect price. Because I know people have been waiting for real estate to come down. They're like, oh, it's too expensive. I'm going to wait. And I mean, home prices just keep going higher. And that's just kind of the nature of home prices. And if any of you on this webinar have tried to do any sort of small remodels, large remodels at your house, you know how expensive that is. And so you just think about the replacement costs on homes to rebuild a house, the manpower that goes into that, the labor required, the materials. So again, I think if it's affordable, that should be the most important factor rather than catching the timing of the peak of the housing market. All right, we got some more questions here. All right, I'm trying to read them and screen them, make sure I don't get too much political woven into the conversation today. So, all right. Okay, so what would you consider minimum long-term and maximum short-term time frame? So the question basically is, when I'm thinking about short-term time frame and long-term. So I do think that investing in stocks and real estate should always be long-term endeavors. And we really look at that window as at least 5 years. In many cases, it would be 7 years. So a long-term outlook should be that 5-7 years plus. Because I do think if you're an investor in stocks and an investor in real estate, if you have a 5-year window, you're probably going to be okay on the other side, meaning making a return on your money. Shorter than that, you just don't know because there's too many economic variables. On a short-term time frame, I guess it's anything less than that, but we truly look at short-term time frames as anything under 2 years. So when people will say, well, hey, I got a tax bill due in April, what should I do with the cash? I don't want to just park it in the bank. I'm not making anything. And our attitude is, well, leave it in the bank because you don't want to lose any of it because it's money you're going to have to pay in taxes, right? So the short-term time frame is we always look at it as a 2-year, and I guess that middle gap is what we would call more of a midterm time frame. So hopefully that's helpful. How many cities will make up the shortfall in revenue due to this virus? What will they take from us? So that's a great question. I know a lot of people are concerned with obviously the slowdown in the economy. The states don't have a printing press like the federal government does, right? So they are trying to, as part of the stimulus package, and one of the reasons why they stalled was because Trump basically said, we're not going to bail out these states. Now, I don't know if that's a totally true statement, but he basically said, like, I don't want to bail out California. I don't want to bail out Illinois. I don't want to bail out New York. And we know that's political. And again, I'm not here to make a political commentary, but it is, right? I mean, you're looking at where your constituents are, how your vote's going to be impacted, and you're looking, where am I going to get the most impact, right? We're seeing that even in all of the, and all the rallies and everything that's happening now, all of their time, Biden and Trump's time is being focused on the areas where they can hopefully sway enough voters, right? So, and that's in an effort to win. So the shortfall in states is going to be really tricky, especially the longer that we lock down. So a couple things. I don't know the answer to how they're going to fix this dilemma, but they're potentially going to either have to raise some taxes, which is going to be hard to do unless we have a really robust economy. We're going to have to get some federal bailout money, which is basically just going to be kind of giveaways, handouts saying, here's the money, we forced you to shut down, here's money. And then that won't be a state taxpayer deficit. It'll be something that's on the federal deficit. And those are kind of those are some of the scenarios. I mean, the unfortunate part with shutting the economy down is this is revenue in many cases that are lost forever, right? So if you think about what's happened in a lot of sports, we have the new stadium here in LA for football, right? And this is all lost revenue. This is revenue that doesn't make its way back into the system. And so my sense is it'll be through some federal bailout money as well as potentially issuing some long bonds, because one of the real benefits of interest rates being so low is municipalities can actually issue bonds and finance some of this. Because if it's a 1-year revenue shortfall, I don't know if they're going to come after the citizens of the state. If it's a multiple year, then they're going to have to, right? Or they're going to have to start cutting, which is going to be tough, right? Where do they cut from? So let's see here. I got another question. Let's see. Additional lockdown and vaccine that isn't widely accepted could create a lot of unexpected recovery. So again, a little bit of a political question, but I'm okay with that. So yeah, I mean, if we have more lockdowns and we go back, I mean, we know we're going into a flu season, which is going to make health issues a bigger issue, right? That's just we know that flu season is going to make this a little bit more challenging. So an additional lockdown would slow the economic recovery down for sure. And that doesn't mean the flip side is the solution, but if we see an additional lockdown, that will slow the progress, that will shut down businesses. So, and if we get a vaccine and people feel like we can get back to some normalcy, that will create confidence to get the economy back on track. So we just don't know right now. 6 months ago when this started, many people thought we'd be done by now. Now I think a lot of us are scratching our heads saying, is this going to be another 9 months? Is this going to be another year? What's really going to happen? So a lot of unknown. I do still have confidence that our system is going to continue to function, but unfortunately, it's with government bailout money, which I don't love, but I don't know what the other option is. I mean, short of just putting all the healthcare issues aside and say have at it and get back to work, which I don't think I don't think most want that. Many do, but most don't. In short of that scenario, it's going to be a kind of a guarded recovery, and it's going to take some time. And who knows, maybe when the election's over, it'll be, all right, let's get back on the same page and start working to rebuild, what's going on, post COVID. So I don't know. That's a little bit of the unknown. What I am pretty confident on, you've seen this in other webinars that I've done, is we are on the verge of a massive economic change, given 5G, given all the technology innovations that we're seeing, and that's not going to be stopped by anything. It could be delayed a little bit, but it's not going to be stopped. All right, so just a couple of charts on here. So I'm going to skip this one because we're going to just run a tad short on time, but let me just show you a little bit of a breakdown. Now, this is proposed, so I don't know if this is exactly, but it's just a little reminder of where personal tax rates were under Obama, where they are under Trump, and the proposed under Biden, because I know people have been asking. This is the data that's come out from the Biden administration as the proposal. They haven't set the brackets, but this is kind of trying to do a apples to apples. And so a little bit of information that there's infighting with both parties, but essentially Biden said he'll get rid of the Trump tax cuts, but then said he'll only raise taxes on the above 400. So basically what that means is he can't get rid of the the Trump tax cuts. He can't get rid of those. He just has to refine where the tax changes are, because if he got rid of them, then what would happen is that Trump has created a 12%, a 22, and a 24. If you got rid of this, then you would go back to the Obama 15, 25, and 28, which would mean a tax increase for everyone. But in the proposal, you can see we're seeing Biden proposing to keep these tax rates and just impacting the greater than 400,000. So that's what's kind of on the docket, is to move back to this highest rate, which, on the surface is not it's not a massive tax increase. There are some other proposals that are looking at increasing above 400,000 on payroll tax, potentially causing some additional Social Security and Medicare taxes. But there is an impact to this. For most people in America, this is not an issue, right? Because the above 400,000, this is the 1%. So again, I'm trying to just give you the information. I have plenty of opinions. You guys all know me. We can deal with that one-on-one. But in this format, I want to try to just kind of give you the data, give you the facts, stick to the facts. One of the things that I do think could be potentially a little bit harmful, a little bit punitive, this could cause some selling. So one of the concerns is if Biden wins, because of the proposed capital gains rates, that we could see selling. And so why would there be selling? Not selling because the economy is going to implode, selling for financial gain. So if you are an investor, let's say we have a few of these, let's say you're an executive at Apple and you have a bunch of Apple stock options, right? And you just have been accumulating them and they're worth millions of dollars and even tens of millions of dollars. And the proposal is that in Biden's proposal is that if you have income above $1 million, that your capital gains rate would be at the same rate as your ordinary income. So right now, if you exercised if you sold stock and had capital gain, you would be paying at 20% federal. The proposal is that if you had a massive sale of stock or you sold a business, that instead of at 20%, you would be at 40%. So that would present some challenges, right? And that would also present challenges for not even those high-level executives that own a bunch of stocks. It would present challenges for people looking to sell a business, right? You look around your town, there are plenty of business owners that have built businesses from nothing to a $10 million business, a $15 million business. This would apply to them, right? If they sold their business and had a big windfall, that, if they built up a business, that basically half of it would go to the government upon a sale, which I do think is pretty punitive. So I guess I am giving you some of my opinion on this. So sorry, I couldn't help myself. But, so you can see here under Obama, under Trump, I think these are fair rates. This new 39.6. So the reason why that could cause a lot of selling, it could also cause business owners to try to sell their business. Unfortunately, the window we're going to have between now and the end of the year is going to be almost impossible to execute on that. But it would be, that is a really big tax increase on that higher capital gains. So those are just some of the nuances that we're seeing. There's still, we got a week here. I'm sure we're ready to have our mailbox stop being stuffed with flyers. If you watch TV at all, you're probably ready for political ads to stop. So hopefully we'll have a very sane transfer of power either way. Once we get through this election, I think it's what America needs. Hopefully that will be the case on either side. that's what we can hope for. So one quick thing. So you guys have been, many of you have been diligently on many of our calls. So, I do have a little bit of a call to action here is that, most people don't have a plan. Fortunately, you work with us. We do have a plan. We do have a tax strategy. So one of the things that we know is going into year end, based on each individual that we work with, if based on the outcome, we're going to know, do we need to take action now? Can we wait till next year? What are the strategies we're going to need to put in place? So we do have a plan. So just a little bit of a call to action. If you know anyone who you think could benefit from more thoughtful planning, because most financial advisors aren't doing this stuff, they're not going through this level of in-depth analysis on the tax side, please connect us. If anything, we're going to be able to make an impact. Most of the time we can make a pretty significant impact and immediate. So we're going to get really busy as we go into year end. So the sooner is better, because I think once we start getting into probably early December, all of our time is going to just be for our current clients. And so if you have anyone that's kind of on the fence that thinks they might need to have a good tax plan in place, let us know, connect us, please. We will do our very best to help them out. A couple things you guys have always seen are our core values. So these are all things that, we try to have great control of here at Vance Wealth. We try to aspire as individuals here, employees, and actually these are the kind of clients that we're looking for that really embody these types of core values: be passionate, positive, and present, committed to continuous growth, inspire balance in life, collaboration drives success, and a healthy urgency to get things done. So these are all in an effort to achieve more. So our team is growing, and we hired 2 people this year. Lauren is not on this, on our picture, so we're gonna have to get that updated. My guess is we're probably gonna hire another 2 people as we go into next year. So, thanks to your guys' trust, confidence, we've been able to serve more people and continue to grow and offer good values. We set up a 10-year plan, which, we work towards every day to try to get better. So thanks for all your trust and confidence. I will see you all back in 2 weeks. So we have our webinar on November 10th at 4:30. So we're going to go back to the 4:30. We just moved it up to 4 because of the game. And if you haven't liked us on LinkedIn or Facebook, please do, because that's where you can get a lot of the updates, and take a look out for our newsletter, which we are sending post-election because we just didn't want to get it mixed up in all of the mail that you're getting at your house. So thank you very much. Let me do a quick little screen here, see if I have any questions. Nope, we are out of questions. And so I'm signing off. Have a good night. Thank you.